There is another vague concept in the trading industry. Of course, there's a lot, but this one particularly, I've never seen a clear answer to it. And the vague concept I'm talking about is, how far can price retrace before we continue? Or in other words, where will price likely retrace towards before we expand again? That is exactly what we are going to go over in this video. Again, adding on to the previous episode, just as mechanical, I will give you another entry opportunity, another entry pattern you can potentially use. Because of course, I am trying to get you to find your own entry pattern that fits your personality. We have a lot of different personalities watching these videos. Exactly the reason as to why I'm showing you multiple entry patterns that you can potentially use. Find the one you like and stick to it. Run away with it and show me your results on Twitter, wherever you want. Let's get into it. So the first thing from the previous episode, what was important again? The context was important, right? The context is the most important part. Again, what was the context in the previous episode? It was moving from this PD array to PD array. Right here, what are we doing on the higher time frame on ES? Again, we are going to go over indices and Forex. Right here, if I go to the daily time frame, we can see we are coming into that daily fair value gap right there. All right, let's just take the daily fair value gap. If we zoom in on the 1 hour again, we can see we had a nice rejection higher. We have a few fair value gaps higher right there. Once we see this expansion higher, all right, we have a great idea. The price might want to continue higher. It might want to continue heading towards a premium array on the daily time frame, which was, we first off have this fair value gap right there. And then afterwards, we of course have this high right there as our ultimate draw on liquidity. So let's stick to that high. Dropping back into the 1 hour time frame, we have this expansion, but what can price now do? What can it retrace towards? First off, what is the range that is causing that move higher? That is causing this expansion higher? It is what? It is that range, this swing low towards that swing high right there. That is aka your dealing range, right? What we talked about in the previous episode. And based on market structure as well, what is now your new intermediate term range? It is this right there. If you want more advanced insights, then don't forget to visit my website ario.io. There's a link in the description as well. Sign up to that newsletter, and that is exactly where I send more advanced insights. So we have determined this is the range from this swing low to this swing high. Then if we draw a Fibonacci right there from that swing low to that swing high, hey, we see a new Fibonacci setting. We have something new to work with. We have 1 and 0. Of course, 1 is that swing low, 0 is that swing high. That is your range. Then we have 0.79, 0.705, 0.618, 0.5, and that makes up your optimal trade entry, OTE. 0.705, that is exactly your OTE level. 0.5 is your equilibrium. Everything above it is in premium. Everything below it is in discount. I can already hear your brain crackling and making these sounds because you're asking, well, what is the relevance of this? Because we didn't even come into that OTE level. Exactly the point. That is exactly the point. I want you to use this OTE as a guideline. But there's something else that is more important. Can you notice something else? Something that we have actually already touched on in the A to Z guide previously, which is overlapping PD arrays. So close to the 0.5, close to your equilibrium, you will likely have overlapping PD arrays. What is an overlapping PD array? An overlapping PD array are just basically summed up two PD arrays at the same exact spot. What do we see here? We have a breaker right here overlapping with what? A fair value gap right there. That makes up two discount arrays. This fair value gap alone is what? It's first in premium, of course, and it is one discount array. There's only one fair value gap with nothing overlapping. That overlapping discount array close to your equilibrium level doesn't have to be in discount, doesn't have to be in discount. Remember that. Doesn't have to be at your OTE level because we will not always reach that OTE level. The strongest magnet before we expand further is the overlapping PD array spot. That is the strongest part. So I'm going to exactly explain how you can use this in your trading plan. Right here, we have this overlapping breaker with the overlapping fair value gap right there. We know already based on a 1 hour time frame and the context, the daily fair value gap right there towards the daily highs right there. All right, we might want to continue higher. So on a 1 hour time frame, what can we retrace into before we continue higher? The overlapping PD array right there, close to equilibrium, perfect, right there, and then we continue higher. Now, will you enter on the 1 hour? That is possible. You can enter on the 1 hour right there. That is already an entry. But I know, of course, some people don't like 1 hour entries. So this is all fractal because now we can dive into the 1 minute right in this area and look for another entry. But first off, before I dive into the 1 minute, what do we need? Well, before we look for an entry, before we see how far a 1 minute time frame can retrace, etc., don't we need some kind of context? What is the context here on the 1 hour? Discount array right there towards what? First premium array right there. Ultimately, this premium array right there. That is your context. If you're entering on the 1 minute, don't think you can target the daily highs. It all is relative. It's all in perspective. If you are entering on the 1 minute, you wouldn't have weekly targets. That's not logical. The time frames are not in alignment with each other right there. Right now, they are in alignment with each other. 1 minute entries, 1 minute targets. That is important to understand. So right here, we go into the 1 minute time frame. All right, perfect. So here we are on the 1 minute time frame. Now, this is your 1 hour breaker, your 1 hour overlapping PD race. Then here we had the first target. Then here we had the second target. Now let's look how we can use the overlapping PD race concept and the OTE concept to get to an entry. First off, I'm not going to dive into how we can potentially see the market shift. That is an episode that is coming your way in the A to Z guide. Don't worry. I just need you to understand that we are moving higher here and that we have a breaker right there. So this right there is what? It's a breaker. With that breaker, we have something overlapping, right? We have this overlapping fair value gap. Now that right there is already your first entry. Let me tell you, I love fair value gaps. Where price will retrace towards and how far price will retrace, the answer lies in overlapping PD rays and in fair value gaps. You first off need a fair value gap. And in every example you will see what I'm showing you here, there's a fair value gap. There's a certain fair value gap right there. Whether it's on the same time frame or a time frame above it, there is a fair value gap right there. Fair value gaps tell you a story. Fair value gap will tell you where price will likely draw towards. And fair value gaps tell you how far price will retrace. Because if there's a fair value gap right there and it's overlapping with a breaker, the rule on your entry time frame right there is enter on the first place where we have overlapping PD rays. An overlapping PD ray is a fair value gap overlapping with another discount array in this case. Of course, if we are looking for short, we would look at a premium array. Where is the first place where we have a fair value gap overlapping with another discount array? This breaker and this fair value gap. Now, if you want to refine it, and of course, be my guest, you can use the OTE right here. And you can draw it like that. Enter on the order block right there, close to equilibrium, overlapping with the fair value gap. Something along the lines of that, right? Perfectly fine. If you want to refine it like that, perfectly fine. But the thing is, you need a set entry pattern that you can stick to. And the reason why this is important, because otherwise you would one time enter on the breaker right there, one time enter on equilibrium right there. That is exactly why I'm giving you the rule. Enter on the first overlapping PD ray. The first overlapping PD ray right there for your entry pattern is this breaker with that fair value gap. Because then you have no excuse to then sometimes use OTE, sometimes use the order block, sometimes use this. No, first overlapping discount array in this case. So boom, there is your entry. Now what would you cover? SL placements, stop loss placements is also something we are going to go into in more detail, one step at a time. But what you're going to cover here is the intermediate term low, which is right there. Perfect, you don't get stopped out right there and we continue higher right there. With the first target being this high, second target being that high right there. Now let's say we wanted to wait a little bit longer again and we saw this expansion higher. Again, expansion, why is it an expansion? This fair value gap higher. In order for us to enter, the first question we always ask or subconsciously ask is, All right, if I want to enter, how far will it actually retrace? That is a question you ask yourself, right? So what will it retrace into? Arjo said the first overlapping PD array. Mitigation block with an overlapping what? Fair value gap right there. So you enter off of that fair value gap right there. Now you notice how I am entering on the fair value gaps because I love fair value gaps. And that is exactly what makes it mechanical. What could also make it mechanical is you enter on the exact spot where we are overlapping with the PD arrays. So for example, that would make the entry a little bit lower right there. That would make this entry a little bit higher right there with the same stop loss placement, of course. Stop loss placement right here beneath that intermediate term low right there. Target, firstly that target, second target right there. And we continue higher. And right here, what happens? Let's see if you paid attention to the market structure video. What happened here? This leg fails, but why? Because this is just a perfect entry, right? Overlapping fair value gap, overlapping order block. But what happens? Remember the structure video. Remember, what do we see? Boom. We take out an intermediate term high. So what is expected? A bigger retracement. So what do we see? We draw the Fibonacci on the intermediate term low towards the new intermediate term high, towards the new target right there. What is close to equilibrium? This order block with what? A 15-minute fair value gap. And the reason I zoom out there is because if you remember, if we retrace after taking an intermediate term high or any intermediate term low, we usually retrace to something on the time frame above it. So the 1 minute needs to be in context of the time frames above it. In other words, you are forming your context again. You need to form that new context again, because if we look this from a very mechanical perspective, like we touched on in the previous episode as well, we moved from this 1 hour discount array to that 1 hour premium array. That is on the lower time frame, an intermediate term high right there. We get a bigger retracement right there. We know that. If we have a bigger retracement and these legs fail, it is because after taking an intermediate term high, we retrace into what? We retrace into something on the time frame above it. And what did we talk about in the previous episode? We hold in the area of context. Price is the highest probability in the area of context. What is the area of context? It is this, from that discount to that premium rate. This part right there, on the right side right here, that is where you want to get involved. After we take out that high, that first target, you want to wait for new context. What is your new context? Equilibrium, 15-minute fair value gap, targeting again that same 1 hour high. Can you see how I'm doing the same exact thing as that we did on the 1 hour? That context first, and then we have a reason to go into the lower time frame. A lot of people don't understand. A lot of people, they go into the 1 minute time frame without having any boundary. There's no boundary. There needs to be a boundary to go into the 1 minute time frame. If you are going into the 1 minute time frame without having a boundary, you will always have a reason to trade. If there's always a reason to trade, then that's not high probability, is it? Because there's always a reason to trade. Everyone can make up a reason in the market to get in. Everyone can justify a trade ID. Everyone. But very little people know when to look at a trade ID and when to get involved. That is the difference. That is what differentiates amateurs from professionals. So afterwards, we reach that on the 1 minute. We continue higher right here. Then what happens again? What do we see? We see this fair value gap reaching only into that fair value gap. Why? There's a breaker right there. Afterwards, again, same story. What do we retrace into? This overlapping with what? This old high as well, that mitigation block now, because remember, this whole move is now a swing failure and a fair value gap right there, order block. This is actually 3 discount arrays, because here you have a fair value gap, an order block, and a mitigation block right there. That is perfect. All right, let's give you one more example. All right, here we are on GBP Australian dollar. Now, the first thing I want you to understand is that we will not always retrace back into an overlapping fair value gap with an overlapping PD array. There are certain conditions when this doesn't happen. These conditions is exactly what we will also go over in a later episode. Don't worry. Right here, first off, what do we need again? Context. We need context. What is the context here? Overlapping discount arrays. 2 overlapping discount arrays, preferably. Minimum 2 overlapping PD arrays. We have 1 fair value gap sitting right there. Then we also have 1 small little breaker right there. Perfect. I like that. Now, if we retrace back into that right there, now we have a boundary. We have a reason to go into the lower time frame. What is the first target? First target is that. What is the second target? Second target is, and the ultimate target is right there. If we head into the 5 minute right here, here we see an expansion, but not a large retracement. And then we expand higher again. All right, no worries. Because if we now look at the overlapping discount arrays again, what is the first overlapping discount array that we encounter? The first overlapping discount array is what? It is this order block right there with that fair value gap right there. Exactly there is our entry. Now, I can hear you think, where would you put your stop loss? Would you put your stop loss right here? No, you wouldn't. You absolutely wouldn't. That is not a great stop loss placement. And let me explain why. Again, we are working with probabilities here. I am doing something that's based on data. I am doing something that works based on probabilities. Again, that is why the belief, the market is not random. That belief is very dangerous. So I know there is a small chance right there that price might do something like this because there's still a fair value gap right there. And this is intermediate term low, right? So we shouldn't take that out. Now, I know, of course, like we've talked about in a market structure video as well, if we haven't taken out that intermediate term high, aka the target right there, then obviously the short-term ranges right here will likely hold until we take that out. But that is based again on probabilities. Nothing works 100% of the time in the market. So right here, this could very well do something like this and then continue higher. And if you've done so much work, you have done so much work based on finding the context, based on waiting, being patient, and then you absolutely mess yourself up on the entry and you miss the boat. You found your entry pattern, the context is there, everything is there, but you mess yourself up and you don't reward yourself. That is the worst thing you can do. So rather than being greedy and finding the best RR and flexing on Instagram and flexing on Twitter, why not giving your stop loss some room to breathe? Putting it at the breaker or even putting it at the intermediate term low right there, covering the bodies of the candles right there. That is perfectly fine. Then you have a 1 to 2 right there. And you have a 1 to 5 right there. That is absolutely beautiful. I would rather actually make money and be a part of the move than constantly getting stopped out because I want the best RR and I want to flex on blah, 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 blah. No, just catch the move. Reward yourself. Reward yourself on the hard work that you've done. So right here, there we get tapped in right there. And there, finally, your take profit gets hit. And that is absolutely beautiful. So again, remember, if you want more insights, more detailed insights, ario.io, sign up right there. And please remember, every Sunday, 8:30, we have a live stream. Feel free to join. We have a big community right there. Huge community full of positive, like-minded people. So feel free to join and feel free to chat. Feel free to ask questions. And I'll see you at the next one. All right, perfect. Thank you.